Have you ever felt that trading in the stock market is a little bit similar to playing a poker hand where luck decides the winner? But did you know that both the stock market and poker involves observation and calculation? The Wall Street is a deep well of money from where everyone wants to throw their buckets and take out a huge amount and create a fortune. But have you ever thought of the biggest takeaway that has been done in the history of Wall Street? There are many worthwhile candidates on Wall Street for the greatest trade of all time. There's Jesse Livermore's bet that the stock market would fall in 1929. He pocketed something like $100 million in profit, akin to $1.5 billion today. There's George Soros's 1992 bet that the British pound would fall against a basket of other currencies. When it did, the Hungarian-American investor made $1 billion. But there is one player that made his mark in history: Alfred Paulson, the man who did the greatest trade ever in the history of Wall Street. Hey everyone, and welcome back to Wealth Professor, the go-to destination to learn personal finance, business, and entrepreneurship. Make sure to subscribe to our weekly videos where we help you become financially smarter without gatekeepers. Stay with us till the end of the video to know what is so special about Alfred Paulson. Born on December 14, 1955, John Alfred Paulson is an American billionaire hedge fund manager. He leads Paulson & Company, a New York-based investment management firm he founded in 1994. He has been called one of the most prominent names in high finance and a man who made one of the biggest fortunes in Wall Street history. In 2006, hedge fund manager John Paulson realized something few others suspected: that the housing market and the value of subprime mortgages were grossly inflated and headed for a fall. Paulson, who knew mergers and acquisitions, knew little about real estate or how to wager against housing. But Paulson saw an opportunity to bet against the market in complicated derivative investments. Colleagues at investment banks scoffed at him and investors dismissed him. Even professionals skeptical about the housing market shied away from him. But Paulson, obstinate, bet heavily against risky mortgages and precarious financial companies anyway. Of course, timing is everything. And although Paulson lost tens of millions of dollars as real estate and stocks continued to soar, he redoubled his bet, putting his hedge fund on the line. Then, the markets imploded in the summer of 2007, and Paulson saw profits. By year's end, Paulson had pulled off the greatest trade ever in financial history, earning more than $15 billion gross of fees for funds managed by his firm Paulson & Company. In a twist of irony, Paulson attended a lunch in 2008 with Bear Stearns that began as an effort by the bank to prevent hedge funds from pulling out and ended with all the other hedge fund managers listening to Paulson and realizing Bear Stearns was in more trouble than it was aware of. As more people took money out of Bear Stearns, it appeared that Paulson had sent the company that rented him his first office space towards collapse. Paulson has continued to trade, having another bumper year in 2010, earning his fund over $5 billion, but has also suffered some notable losses. He is still a major player and has more recently moved into the gold market. Since the beginning of the year, its flagship fund, Advantage Plus Fund, which tries to take advantage of special situations related to businesses, such as takeovers and bankruptcies, is down more than 31%, according to a person familiar with the structure. John Paulson has reduced its bullish bets after losses this year and warned its customers in June that it has reduced its stake in Bank of America Corp., where he was the 9th largest shareholder with nearly 124 million shares at March 31, 2011. The shares of the bank tumbled 47% since then. More generally, financial firms have shaken the Paulson Fund. Among the top 10 of shares held at the end of the first quarter, the half was made up of companies in financial services. Citigroup Incorporated, the third largest line, dropped 37% since the beginning of the year. Hartford Financial Services Group Incorporated, the sixth largest participation, fell by 28%, and SunTrust Banks Incorporated, the eighth largest participation, fell by 37%. With this poor performance, Paulson will perform about 45% the rest of the year to provide a positive return on the Advantage Plus fund. He is thus forced to take significant bets and being right. Last year, after poor performance in the first three quarters, Paulson had ended the year with a strong performance, and financial stocks had greatly contributed to the rise of more than 17% of its fund at the end of the year. After being down 11% at the end of August 2010, the gossips were wondering if he will be saved this year, regarding a QE3 in preparation, as he has been saved by the Fed QE2. To reassure investors and bring confidence, Paulson sent them a note last week telling them that the amount of redemption requests on the Advantage Plus fund, which had $15.7 billion of assets at August 4th, were lower than the amounts required by customers a year earlier, as well as quarterly redemptions for the past 2 years. In all cases, the redemptions would not shake the Advantage Plus fund, in which Paulson and his employees account for 36% of the assets. Paulson contributed $140,000 to political candidates and parties between 2000 and 2010, 45% of which went to Republicans, 16% to Democrats, and 36% to special interests, including former House Speaker John Boehner. In 2011, Paulson donated $1 million to Mitt Romney's super PAC, Restore Our Future. On April 26, 2012, Paulson hosted a fundraiser at his New York townhouse for Romney's presidential candidacy. Paulson received media attention after immediately banking Trump after he secured the GOP nomination. Paulson served as one of the top economic advisors to Donald Trump's 2016 presidential campaign. In 2008, Paulson co-wrote a Wall Street Journal op-ed piece suggesting an alternative to the Treasury Secretary's plan for stabilizing the markets. The alternative plan included recapitalizing the troubled financial institutions by spending the $700 billion Troubled Asset Relief Program funds to buy their senior preferred stock rather than their worst assets. In 2008, while testifying before U.S. House Committee on Oversight and Government Reform, Paulson was asked about the low tax rate on long-term capital gains and carried interest earnings, and Paulson replied, "I believe our tax situation is fair." In a 2012 interview with Bloomberg Businessweek magazine, he expressed displeasure over the Occupy Wall Street movement, noting, "We pay a lot of taxes, especially living in New York. There's an almost 13% city and state tax rate. Most jurisdictions would want to have successful companies like ours located there. I'm sure if we wanted to go to Singapore, they'd roll out the red carpet to attract us." At the 2014 Puerto Rico Investment Summit in San Juan, Paulson stated, "Puerto Rico will become the Singapore of the Caribbean." Paulson was reportedly investing the territory's municipal debt in real estate developments and was building a home at a resort. Between 2009 and 2011, Paulson made several charitable donations, including $15 million to the Center for Responsible Lending, $20 million to New York University Stern School of Business, an auditorium now named after Paulson, $5 million to the Southampton Hospital on Long Island, $15 million to build a children's hospital at Guayaquil, Ecuador, and €2.5 million to the London School of Economics for the John A. Paulson Chair in European Political Economy. In October 2012, Paulson donated $100 million to the Central Park Conservancy, the nonprofit organization that maintains New York's Central Park. At the time of the donation, the gift represented the largest monetary donation in the history of New York City's park system. In June 2015, Paulson donated $400 million to Harvard University's School of Engineering and Applied Sciences, SEAS, the largest gift received in the university's history. Following the donation, the engineering school was renamed the Harvard John A. Paulson School of Engineering and Applied Sciences. The next month, he gifted $8.5 million to New York City's largest charter school organization, Success Academy, to improve public education and open up middle schools in the Bedford-Stuyvesant area of Brooklyn and in Hell's Kitchen area of Manhattan. In 2017, Paulson and his wife wrote a letter to the elite Manhattan school Spence, threatening to withdraw aid if the school continued its alarming pattern of anti-white indoctrination. In the letter, they stated, "In fact, for children of all races, we strongly believe that schools should value and define success in terms of hard work, earned accomplishment, merit, a commitment to academic rigor, and personal integrity." Gregory Zuckerman even wrote a book about John, the greatest trade ever. Gregory Zuckerman chronicles the unparalleled and unprecedented trade executed by John Paulson, with the help of analyst Paolo Pellegrini and others at Paulson's firm. The book provides insider insight into how Paulson and others profited from the subprime market's demise. In doing so, it details not only Paulson's experience, but the experience of other individuals pursuing the same historic trade. Jeffrey Green, an investor who emulated Paulson, Michael Burry, an investor who read the same problems in the market correctly but had poor timing, and Andrew Ladd, the hedge fund manager who succeeded like Paulson but on a smaller scale, and then infamously penned a colorful goodbye letter to Wall Street. None of these players, however, had quite the smarts, good timing, and touch of the renegade of Paulson, according to Zuckerman. On a single morning in 2007, when gung-ho subprime lender New Century announced it was in trouble, Paulson's fund clocked up gains of $1.25 billion, more than his idol George Soros made in the notorious gamble against sterling in 1992, when Britain was forced out of the European exchange rate mechanism. Early last year, Paulson was weighing whether to convert his hedge fund into a family office within the next year or two. He had said his own wealth made up 75% to 80% of the firm's assets. Paulson & Company was founded in 1994 with a $2 million investment. The fund managed roughly $9 billion as of 2019. Paulson cited fellow hedge fund managers George Soros and Stanley Druckenmiller as two investors who had moved on from wealth management to focus on their personal fortunes, and ones he could follow. Paulson netted huge profits for his clients by making bets against the U.S. housing market. Between 2007 and 2008, that trade paid off spectacularly as he managed to net $20 billion in profits for clients and employees. His own personal gains at the time stood at nearly $4 billion, one of the largest fortunes accumulated from a crisis in the history of financial markets. With one chapter closing, a new one is beginning for me, and I look forward to continuing as an active participant in financial markets, Paulson wrote in his letter to investors. That's it for today's video. If you learned something new from it, make sure to subscribe to our channel. And while you're here, click on one of the videos on the screen. See you there!